All right, guys. So let's do an ECB warm up here. It's just like that period before the 100 meters final. You know, you've got to do your stretching, get your warm up ready, get your body ready, and then everything's going to happen pretty short and sharp as we get news flow coming in at 12:45. So let's get set for this. Let's do this in order. The order is going to be what is happening in the Eurozone economically. Why then are the ECB looking to do more? Then what more can they do? What do markets expect? What do we expect? What's the kind of order of events? When do we get what information? We'll have a quick look back at how markets behaved during the last ECB press conference, and finally look at how we anticipate markets to behave this time. That's the plan of action. Let's assess the Eurozone economy before we look at these charts that I've got here. I'm just going to bring up a few graphics. Firstly, here looking at inflation. You know, one of the key reasons why the ECB have finally stepped up this year and delivered zero interest rates plus their first quantitative easing package ever is because of the fact that we hit deflation at the start of the year. Okay, now this is quite a long-term chart here. We're going back 15, 16 years. It's comparing CPI with the level of interest rates set by the ECB, and then we've got a dashed line horizontally at 2%, which is the ECB's inflation target. Okay, so we're right down. I mean, we dived into negative territory in January. We rebounded, so it looks like all the efforts done at the start of the year had a much quicker effect than we thought. It's just that things have drifted back lower. We briefly dipped into negative territory again on inflation couple of months back, then we bounced. Now the inflation numbers for November, i.e. that were announced earlier this week, came in a touch below expectation at 0.1%. But look, in the grand scheme of things, inflation is a million miles below the target. And whilst we got excited earlier in the year that we'd seen the worst, the deflation risk has gone away. As we've gone into quarter 3 and now into quarter 4, the fear is the deflation risk is back. And this is one reason why the ECB are going to do more. It's not a question of are they going to do more or not. They definitely are. The big question mark is how much more. And this is what's going to move markets. But this is just to give you an idea of where interest rates are. You know they're at 0.05%, although this is the refi rate, and this is not it's probably not the important interest rate today. It's going to be more about the deposit rate. Let's have a look at a couple of other things here. One interesting chart for me is this one. This is looking at the Eurozone PMIs, looking at manufacturing and services, and then mapping it onto a chart of where interest rate changes have occurred. I think this is really interesting. Can you see anywhere on this chart? This goes back since the ECB was created, okay, the end of the 90s. Is there any point on this chart where PMIs are above 50 and the ECB have cut rates? That's a question I'm going to answer for you. No. Sorry, yes, apologies. Damn it. Sorry, yes, twice. Once start of 2014, once end of what is that? Midway through 2015, sorry, 2014. So we have had 2 rate cuts, apologies. We've had 2 rate cuts whilst PMIs have been above 50. It's just that all these rate cuts, we do have a PMI number that is higher. Well, let's put it this way. If they cut rates today, it will be them cutting rates at the highest ever PMI reading. Okay, PMIs, as we've been talking through the week, really good lead indicator towards sort of current and future economic conditions. So we've seen an upturn. We've got PMIs at 18-month highs, indicating there's a bit of momentum building in the Eurozone economy. So this is a chart for those people who think that Draghi will disappoint today and under-deliver. It's these kind of measurements that are in favor of that view, okay? But, when you're looking at inflation, as I've just shown the chart before, this is certainly a chart that supports the idea that Draghi is justified in doing a lot more. But there's a reason why inflation is so low. If we look at the commodity index here relative to Eurozone CPI, then we know that it's mostly a commodity story. There is an underlying weakness as well, don't get me wrong. Even if you take commodities out of it, core CPI is still too low. And that was something that happened earlier in the week. Core CPI dipped again back to 0.9%, plus 0.9%. So that's definitely still too low. But the reason why headline CPI is by next to zero is because of this wave lower in the commodity index. Okay. Let's have a look at what else can I show you on this graphic? Let's look at the ECB balance sheet. This is asset purchases. They did a load of purchasing, but this wasn't QE back in 2011 and 2012 that saw their balance sheet rise to 3 trillion euros. This was not officially QE. This was their LTRO program. Then that LTRO, which was a loan, essentially, a 3-year loan, and that loan got paid back, and so their balance sheet dropped and dropped and dropped, and it dropped back to 2 trillion, which was this kind of post-crisis level. And the idea has been for Mario Draghi to return the balance sheet back to 2012 levels. Okay, this is why we've got a 1.1 trillion QE package, and we're kind of on our way, and they're delivering this package. Okay, and by September 2016, the current package will see their balance sheet get back up above 3 trillion, like it was back in 2012. So we'll talk about QE in a minute. And we'll talk about deposit rates. I'll come back to this chart in a minute, because when we talk about the deposit rate and what they might do with it, this chart's pretty interesting and perhaps gives you an insight into why they might be looking to cut the deposit rate. But I'll come back to this. Firstly, let's focus our attention on what can the ECB do today. Now, we sent you out this report. Anthony did a really good summary here. And let me just make this a bit larger. So you've had this in your inbox. You should have read this by now. If you haven't, definitely need to before 12:45. You've got an hour and 15 minutes. But this is just looking at an overall summary and looking at what the banks think. And of course, there's a big spread of different views and opinions. And let me come back to these actually. Let me just scroll down and perhaps use this graphic to start with, just to explain what might they do. This is something that UBS put together. And there's kind of 3 things, but it's not just as straightforward as 3 things, because then there's several kind of sub-factors within each 3 categories. But the big 3 categories are interest rates, the time frame of quantitative easing, and the amount of monthly purchases of quantitative easing. These are the 3 big categories, okay? And the question is, are they going to deliver on all 3 fronts or not? Now, as we've got closer and closer to this meeting, I think expectations have just gone to irrational levels. And I think that markets want more than they're going to get. I think markets are really pricing for the ECB to deliver on all 3 fronts. That is, cut interest rates. That is, extend the QE program beyond September 16 and extend it by at least 6 months to March 2017. I think also markets have, and this is where I think the irrationality comes, I think they're also expecting the ECB to increase the rate of monthly purchases. Currently, we're at 60 billion a month, and markets want more. This is where I differ with, I think, the market consensus. I think we will get rate cuts. I think they will extend the program. I don't think they'll change the speed of it, the amount of monthly purchases. Of course, I could be very wrong. We'll talk through the options now. So with interest rates first, I think markets are expecting the deposit rate to be cut, and that's it. There are some in the market, there are some of the banks who are expecting more, not just the deposit rate cut, but also a refi rate cut. Let's have a look at this graphic here from the FT. This is looking at the refi rate and it's looking at the deposit rate. Okay. One thing to note here, if nobody's talked about the lending rate, what might happen, I think they'll cut the deposit rate and not cut the refi rate. And I think that's market consensus. There's only a few outliers who think the refi rate's going to be cut below zero as well. Market consensus is deposit rate cut. It's just how much. And I would say 10 basis points. There's others that think 20. So it's at minus 0.2% at the moment. I think probably markets expect, well, just over 10 basis points. If you talk to UBS, they've kind of measured it as markets are pricing in a 13.5 basis point cut. That would be, I mean, that won't happen. They'll either cut it by 0.1% or 0.2%. So we're either going to get the deposit rate move down to minus 0.3% or down to minus 0.4%. The only reason I mentioned the lending rate, which actually I haven't seen anybody talk about at all, if they do leave the refi rate unchanged, but this is going back like into 2014 now, they often talked about the interest rate corridor. This is the difference between the three rates. We've only got the two rates on this chart, but the lending rate is above, right? And as it stands, what they like to have is the interest rate corridor being uniform, which means the difference between the refi rate and the deposit rate is the same as the difference between the refi rate and the lending rate. So as it stands, the deposit rate is 25 basis points below the refi rate. The lending rate is 25 basis points above the refi rate. If they chop the deposit rate and make it lower, will they increase the lending rate? I don't think they'll want to do that, but it's just something to think about. It's a minor point. But if they start talking about the lending rate at 12.45, then you'll kind of know what they're talking about. But at the moment, the lending rate's at plus 0.3%. It's likely going to stay there. I think they'll cut the deposit rate by 10 basis points down to minus 0.1, down to minus 0.3. Okay. I'll just flick back to that chart quickly I was showing you. This is the overnight deposits at the ECB. You can see a monster explosion in overnight deposits back in 2011, 2012, and this is the LTRO operation, which is where banks borrowed money off the ECB and then just deposited it back at the ECB. This then got paid back, of course. But what we've seen through 2015 is slowly but surely deposits creep back higher, and I think the ECB don't want this. They don't want deposits at the central bank. They want banks to lend it. They want banks to use this money, put it to use, let's get the economy growing. So the reason why they want to cut the deposit rate is to try and incentivize banks to lend more. Whether this happens or not, there is policy error risk here. I mean, has it worked? We've had a deposit rate in negative territory all year. Has it worked? Well, this chart says no. I mean, if it had have worked, you wouldn't have seen deposits at the ECB rise. But you could point towards some of the economic factors, those PMIs, for example. We have seen growth in 2015 better than it was in 2014. So there are some signals that say conditions are improving. But I think the ECB want to do more. It's just, will banks say, okay, fine, ECB, if you're going to charge me more to deposit at your bank, I won't deposit. I'll withdraw my deposits and I'll lend it out into the economy. Are banks going to do that? Or are they going to say, well, fine, you can charge us what you want. We'll just make the customer pay by increasing customer bank charges. That would be a backfire. That would be where this cut in interest rates designed to be an economic positive could actually turn into an economic negative. So there is risk that this policy doesn't work. It very much depends on how the banks behave in the face of an ever-increasing negative deposit rate. Okay, so the first thing to think about, at 12:45, are they changing interest rates? Whether or not they do more, we most likely will not hear about at 12:45. At 12:45, what we're expecting to hear is just changes to the interest rates. And there's 3 interest rates, remember. There's the deposit rate. That's what everybody's listening out for. How much are they going to drop it by? There's the refi rate at 0.05%, probably aren't going to change it. But if they did and cut that into negative territory, that would be historic. You know, that would certainly that would be a surprise. And then are they going to change the lending rate? Probably not. It's currently at 0.3%. Now, the key here at 12:45 is we are expecting another comment, and we're expecting the comment to be the ECB is to release further measures at ECB President Draghi's press conference at 1:30. We need that line in the headlines, 12:45. That when you go back to January was when they rolled out their quantitative easing program for the first time. They did not announce this at 12:45. They left it for Draghi to announce in the press conference. But at 12:45, they had that line in their statement. So I'll just repeat that. They said, in fact, this is back in January. They said we're cutting interest rates, but they also, actually no, sorry, they didn't cut rates in January. Apologies. They said we're leaving rates unchanged, but they added the line, the ECB is to release further measures at ECB President Draghi's press conference. We absolutely need that line to be delivered at 12:45. If it's not there, if all they do is change interest rates and there is no line saying further measures will be announced at the press conference, that will be a big disappointment. Markets are pricing in an extension of the QE program. This needs to be hinted at 12:45, but probably without any detail. Now, they might change things up, though, and this is where the uncertainty comes. Who knows? They might actually decide at 12:45 to give us detail about how they're changing the QE program. That would be a change from how they normally deliver information, but they might decide to do that. So who knows? You've got to be on your toes here. But I would say what markets are expecting is a cut to the deposit rate. It's just how much? 10 basis points or 20 basis points. And they're also expecting that line, further measures to be announced at the press conference. Okay. Then it obviously moves to Draghi at the press conference. And what's he going to do with quantitative easing? And here, the 2 separate issues are they going to extend the program beyond the September 2016 deadline? I would say markets are pricing in yes, and they're pricing in a 6-month extension. They could do 12 months. Who knows? They might even say, you know what, we're scrapping an end date. It's going to be a Fed-style open-ended QE, and we'll just stop it when we think the economy's recovered enough. They might do that. I doubt it. I would say 6 months. I think 6 months. I think they're willing to commit to 6 months more at this point, but no more than that. So any more, if they extend it by 12 months, that would be, I would say, above market expectations. If they scrapped the end date and said it's open-ended, that would definitely be above market expectations, and you'd see a positive reaction to that. But you'd only see a positive reaction if that's taken in isolation, because there's other things. Are they going to change the amount of purchases that they make each month? And this is where it gets pretty complicated. Currently it's 60 billion a month. Are they going to change it? If so, by how much? Would it be 5 billion? Would it be 10 billion? Would it be 15? Would it be 20? I mean, Who knows? It could be 30, right? But the point is, the larger the amount of monthly purchases, the more concern there is about how much available assets are there to purchase. Can they purchase more than 60 billion a month? And so what they're going to need, if they do change the amount of monthly purchases, what they're absolutely also going to have to do is change and expand the available pool of assets. Otherwise, if they said we're going to increase the monthly purchases by 20 billion and we're going to extend the program to March 2017, and then that's it, and they didn't announce an expansion of the pool of assets available, I would actually think that policy decision would carry no credibility at all. Markets would say, well, all right, that's all very well and good, you saying that you're going to do that, but actually we think it's not possible. So if they do increase the monthly purchases, you're going to have to see one of or both of two things happen. And this is now talking about the available assets, because it's all very well and good saying we're going to deliver a QE package, it's going to be 70 billion a month. It's all very well and good saying that, but the practicalities of delivering it also need to be considered. What Deutsche Bank did here was just put together a list of the amount of assets available. Now here, mostly they're buying government bonds, right? And this is where we're going to need to see, well, what order shall I explain this in? Well, let's just look at this table for now. So here we've got the different countries split out, and we've got the, so PSPP here, this is the government bond purchases, right? And so in up to 2016, January 2016, these are the amounts that are available, or in the case of this left-hand column, the amounts that have been purchased. Now what this isn't the total amount of German debt. It's 33% of the total amount of German debt, because the ECB have a rule. They're not allowed to buy more than 33% of any one country's government bonds. Okay. Now, when we flick into total current eligible universe, how many bonds are available? How many German bonds? How many French? How many Italian? How many Spanish? And so on. And this is where we currently stand. Okay. It's 1.7 trillion euros. Now you might think, well, okay, that's fine, because the current program is 1.1 trillion, and if they expand it by 6 months, then you're adding another 60 billion a month, so you're adding another 360 billion. So we're still well within this 1.7 trillion, right? But no, you can't think like that, because this is the total amount available. But the ECB can't buy if nobody wants to sell. The ECB can't force banks to sell them these assets. So this is the total available amount, but in practical terms, there isn't this amount available. So what we're going to need to see, when you include new issuance in 2016, these numbers go to actually 2 trillion in total, but there's two ways the ECB could increase the amount of assets available for purchase. Two ways. The smaller way is to add on basically municipal bonds. So to say we're also going to be prepared to buy not only government sovereign bonds, but also regional government municipal bonds. This would see an increase of about 90 billion to the available pool of assets. Now, 90 billion ain't much, let's be honest. When you're buying at 60 billion a month, if not more, if they increase it, then 90 billion more ain't going to last you very long. So this would be a small increase. I would expect them to announce this. They've communicated this a few weeks back. My view is they will extend the QE program to March 2017, and I expect them to announce they're also going to be buying municipal bonds. Okay. The bigger decision, and therefore which would carry a larger market impact, would be this column here. Do they remove the yield floor? The other rule they have at the moment is they can't buy government bonds that yield below the deposit rate. So you might say, well, this is one reason why they'll probably lower the deposit rate. to try and bring more bonds into the available purchase category, but lowering the deposit rate will most likely lead to bond yields dropping. So how effective, just cutting the deposit rate, will that lead to an increase in the available bonds? Maybe not. So one thought is they might say, you know what, we'll scrap that yield floor. So forget about that rule. We'll just buy whatever we want. It doesn't matter what the yield is. Now that would be a bigger decision and would actually lead to the pool of assets increasing by almost 400 billion. This is a much bigger decision. So that I don't think I don't think we're priced for this. There's some people who think this is going to happen, but they're in the minority. So I think a positive surprise, if Draghi is to somehow beat expectations, you're going to need to see something like this happen, scrapping the yield floor. I think if Draghi wants to properly beat expectations, he needs to scrap the yield floor and he needs to increase the pace of monthly purchases by 10 billion or more. I think this is where you're going to see Draghi beat expectation. I don't think this will happen for what it's worth. On the chart on the right here, and actually let me maybe just go back up to the top, and you read this in the email, just thinking about if they change the QE program, how long can they go? And actually, sorry, it wasn't in this. So basically, so if the ECB continue to purchase at the current pace, right? If they don't change it and it's 60 billion, and if they did remove the yield floor, then they could buy bonds up to October 2018. So they do have room to increase the program by 24 months. That's if they don't increase the pace. If they upped the monthly purchases to 70 billion, well, then this gets them, they could get through to May 2018. If they up the pace by 80 billion, they could buy assets right the way through to January 2018. This is if they expand the pool of assets. Okay. Right. Any questions on this? Just kind of get them in the room. Now, so what we've spoken about there is, what are the different options for them? Thinking about the deposit rate, thinking about the refi rate, thinking about the time frame. Currently September 2016, will they change it? Thinking about the pace of monthly purchases. I haven't even gone into the fact that actually, with a deposit rate cut, that's not straightforward either, because will they split it and make the rules different for core Europe relative to peripheral Europe? So yeah, this is so complicated. The point here is that it's very complicated, and the main point to add after that is that market reaction can be chaotic when you're trying to get an ECB delivering a very complex set of measures that have a lot of detail to them, that's hard to decipher, and it's hard to kind of think about all the different policy decisions that have made, or all the decisions they've chosen not to make, and all the detail underlying those, and how do you add it all up and make an overall judgment how markets are going to behave and respond? It's pretty difficult, to say the least. Let's look at how markets behaved last time. Let me bring in a few charts here. Last time, this was October the 22nd. And basically, Draghi pretty much promised action at the next meeting, okay? And so markets moved pretty dramatically. What I've got here is just a few charts of that day, that afternoon. This is just to give you a sense of how far can markets move here over what kind of time frame. Let me just get this so you can see all three properly. So I've got the euro dollar on the left, I've got the DAX on the top right, I've got the Bund on the bottom right. Mario Draghi promised to cut rates. he promised to do more with QE. This is back on the 22nd of October. These are all set to 5-minute time frames. So this was after the press conference. As the press conference started, the euro-dollar dropped from 113.20, and by 2 p.m. we were trading down at 111, or let's just say 112. All right, so we had a 120 pip move in the first half an hour. Okay, but as you can see, the euro-dollar then trended lower for the rest of the day, and in the end, we almost hit the 111 handle. This was a 200 pip move to the downside, purely as a result of what Draghi said. All right, 200 pips, half of that coming pretty much immediately, with the other half happening through the session. How did this play out for equity markets? It was taken as very positively, of course. You know, more stimulus, good news, and the DAX tracked higher. We started off around about 10,000. Well, let's say 10,280. By the time we got to 2 o'clock, we were at 10,400. So over a 100-point move to the upside for the DAX in the first half an hour. Then we trended higher for the rest of the session. We almost hit 10,600. This was over a 300-point move, a 3% move to the upside for the DAX. Check out the Bund down here on the bottom. This is reacting to yields rising as we price in more deposit rate cuts, yields rising as we price in more QE purchases. So the Bund started off at 156.50 and just in 5 minutes rallied 80 ticks. In the first 5 minutes, 80 ticks. We then pulled back half of that, pretty much perfectly to the 50% fib. Then we rallied again through the session, and in the end, you know, ending up right up around 157.70. So, you know, well over 100 ticks, you know, 120 tick move to the upside for the Bund. Okay, so you can see what you're going to get, as always. This time we are going to get movement at 12:45. On these charts, you can see there was no movement, and that's because they didn't announce, there was no rate cuts. That's what gets announced at 12:45. Rate cuts. Okay. There was no rate cuts, but he delivered a promise in the press conference. So this time we are going to get movement at 12:45 because there's uncertainty on how big the deposit rate cut will be. So let's maybe look at the charts. Get rid of these ones from 6 weeks ago and look at the charts now. What we've had this morning is, and actually, let's just look at Europe here. So let's get rid of the oil and let's get rid of the SP. Let me make these European asset charts a bit bigger. So let's get the Bund and the euro dollar on the bottom, and let's just get the DAX here on the top. Now, of course, the biggest action is going to be in European assets, obviously. So what we've had this morning is a bit of optimism. When you're looking at equities, we rebounded all of the losses from yesterday. You know, the Yellen hawkish losses seen into the US close last night have been reversed, and we're right up back at yesterday's highs. All right, so we've had quite a bit of cautious optimism. This is really markets saying that, okay, here we are, we're on D-Day and Draghi Day, and he's going to deliver. Okay, at least what markets expect, if not more. That's what the euro's saying as well. We're back down testing yesterday's low. This is the 7-month low. Okay, so, or even 8-month low. So the euro and equities are saying Draghi is going to over deliver. The Bund, nothing. The Bund's gone nowhere. It's quite interesting to see that what bond traders are saying are, well, we're optimistic, but we don't want to be too optimistic. So you've not seen the Bund join in on the FX and the equity moves this morning. So 2 events, 12:45. How will markets react? There's 3 scenarios. No change to interest rates would be the biggest event that could possibly happen. We are expecting at an absolute minimum an interest rate cut. And if they don't even do that, well, then that would be a massive surprise. That would be the big surprise, right? Everybody's expecting the world, and if they deliver nothing, that would definitely be the biggest surprise, okay? What you're going to see is the euro dollar drives strongly higher. You're going to get equities sell off sharply, and you're going to get the Bund also take a big hit to the downside here as yields rise, because we're expecting, and if they don't cut interest rates, and let's say there's no sentence, we will release further measures at Draghi's press conference, this would be the big event of the session. It would be the easiest trading opportunity. It would be the big surprise with no confusion, no confliction. You could get massive movement at 12.45. Euro dollar, I mean, where could the euro dollar go? We'd have to go to a daily chart to figure this one out. Because look where we've gone over the last few weeks. It's just one way. You could, I mean, if they did nothing, you could get the 110 handle tested. Now, I know that's 450 points above where we are now. I think that is not unrealistic. If the ECB do nothing today, I reckon you could get a 400 pip move in this FX market. It's so unlikely, but that's what will be my view. Where would the DAX go? Well, certainly down through 11,000. Okay, so you get easily a 300 point sell off in the DAX. Where would the Bund go? Well, easily 100 ticks, easily, if not 150. All right, it's not going to happen though. They are going to cut rates. So the question is by how much? Markets are priced for just over 10 basis points. So they're either going to cut by 10 or 20. They're not going to cut by 15. I doubt. So they'll probably either choose 10 or 20. If they cut by 10, this might be taken as a slight disappointment. I think then what will be more important is that sentence also announced at 12.45, further measures to come in the press conference. If so, then I think a 10 basis point cut, whilst mildly disappointing, will be okay. You know, we won't freak out. You won't get big moves. So I think the scenario where markets move the least at 12.45 is a 10 basis point cut to the deposit rate and an announcement that there's further measures to come at the press conference. I think then you really got to hold back a bit. The main action is going to be off the press conference, okay? But a 10 basis point cut might see initially the euro popping higher. You might see the Bund maybe coming off a little bit. Maybe you'll get a bit of downside. So just on the DAX, just to be clear here, if markets are disappointed, the euro rallies, equities and bonds sell off. If markets are disappointed, if Draghi over delivers, you get the opposite. You get the euro weakening and you get bonds and equities rallying. Okay, that's going to be the correlation here. It's going to be very unlikely to see any other correlation. If you get a 20 basis point cut and there's a line, more measures to be announced in the press conference, then you are going to get movement here. And if they cut the refi rate as well, then you're going to get some decent action at 12.45. And you're going to see the euro sell off. That's where the markets will be happy. Euro sells off, equities and bonds rally. If it's a 20 basis point cut and they cut the refi rate and there's the line that we're going to announce more in the press conference, that's where you're going to get a positive reaction in markets, and that would be an over deliver at 12.45. Okay. All right. Let's talk about the press conference then, because that's only just the first bit of just the first half. We're then into kind of the second half, which is Draghi announcing. First, you know how the press conference works. He makes his statement, and that will be massively, massively important. It will be in his opening remarks that he tells us what they're going to do with QE. Markets want a 6-month extension, okay? I would say if they do nothing to QE, they leave it exactly as it is, that'll definitely be disappointing. The markets will be disappointed with that. One school of thought is they might do a larger deposit rate cut which is a positive, to offset the negative of no action on QE. That might be one idea. But if they don't alter QE, that's definitely a disappointment. Even if they cut the deposit rate by 20 basis points, if they don't alter QE, I think overall you're going to get a disappointed market. I'd expect him to announce, firstly, that they're going to extend the program. So here's the important thing. Is it going to be 6 months? Is it going to be 12 months? Are they going to have it open-ended? I reckon 6 months. If they do more than 6 months, this is more than what markets expect. It'll be a positive. If it's 12 months, you're going to see equities rally. You're going to see bonds rally. You're going to see the euro sell off. Okay, you're going to get that market a happy reaction if it's 12 months. If it's open-ended, you'll get an even stronger happy reaction. Okay. Then if they deliver the absolute ace card, they're also going to increase the amount of monthly purchases. I don't think they will, but if they do, this is like Mario's trump card. This is where he can seriously over-deliver, okay? He can deliver more. And then it's a question of by how much. So is it going to be, I would say they'll probably choose increments of 10 billion. That would be my guess. So it's either going to be we'll extend it by 10 billion or we'll extend it by 20 billion. I don't think this will happen, but some Deutsche Bank think this is going to happen. They think 10 billion increase to monthly purchases to 70 billion a month. Then if they do that, though, they're going to have to increase the pool of assets available for purchase. So we talked through that. Are they going to start buying municipal bonds? Are they going to scrap the deposit rate floor? Okay. All right. I think I've probably given you enough here. One final point to make. We got 40 minutes to go. One final point to make. You're going to get a lot of action no matter what happens. Okay, because there's uncertainty here. There's a lot of chaos. There's a lot of volatility. You're going to see order books thin out. You're going to see short, sharp reactions. You're going to probably see conflicting announcements, which is going to create this noise and volatility. It's a very dangerous period to trade, but it also carries big opportunity. But I'd say be careful. It's easier to lose a lot of money in this event than it is to make a lot of money. But if we do get a dramatic, I'd say the easiest trade is at 12:45. They announced no change to interest rates. That's it. No, there's no line about more measures in the press conference. That would be an absolute no-brainer, monster move. As I said, with the euro dollar, easily 400 pips. The Bund and equities will get killed. That would be the easiest trade and the best trade, but it's not going to happen, I'm afraid. They are almost certainly, I think they'll cut the deposit rate by 10 basis points. I think they'll extend the QE program by 6 months. I think they'll also extend the asset pool by saying they're going to buy municipal bonds. I think they'll leave it at that, and I think that is below what markets expect. And I think overall, you'll get a disappointed reaction. Okay. All right. Good luck, guys. Be careful. Keep that risk tight. We've got 40 minutes to go.